Matt, I
I
have
have
no
a share
sound.
system audio. Yeah. And I believe we may be live, so I'm going to start talking here. Good morning, everybody out there. We're going to get rolling. All right, very good. Matt, how you doing this morning?
Doing good, Tim. How you doing?
Good. Halftime report here. Day before the Fed meeting, Trump's in front of the UN talking about politics and trade and tariffs and all that kind of stuff. A little bit in the news. Markets are relatively flat and in wait and see mode. Excited to kind of break down the markets today. And I do have some really good trade ideas out there for our halftime crew. So excited to rock and roll. Let's start with the S&P 500 here, the ES contract. 1 point up, and I was looking at the futures market in the pre-market. We were up like 4 points. We had consumer confidence numbers this morning, a little bit of news, Matt, but that's the definition of a doji.
Oh, it's a doji. Nothing's happening today.
Yeah. So how do you interpret that? You got a big meeting tomorrow. Most important economic event we've had all month is tomorrow with the FOMC announcement. Whether it does end up resulting in volatility or not, I think that's fair to say that it's probably the event we've been waiting for, right?
It is the event we've been waiting for, but I do want to say, and I do want to suggest that most of the time, Tim, that these meetings they come and then they go, right? You really don't see massive volatility around them. Now, they are days like tomorrow with the Fed announcing interest rates tomorrow. There are days that have the ability to drive volatility unlike other days, and tomorrow is certainly one of those. However, in our history, we really haven't seen that, right? We know what the Fed's going to do. They've basically stated what they're going to do. They're going to raise a quarter of a point, and then they're going to put out their policy statement, and then they're going to have some interviews and some speeches and some Q&A. And so it certainly has the ability to drive the market. But if you track the Fed meetings from 2010 until today, most of the time, Tim, it's just a normal day in the market, right? Most of the time you don't see massive volatility. So it's one of those days where you prepare for it, but it's like in the back of your mind, you're like, okay, we get these every 6 weeks. It's not like this is some random event, the black swan type event, those types of things. We know what's going to happen. So the most likely scenario is they're going to come out there and raise a quarter of a point. They're going to give a statement very similar to what they've given in the past, and the market's going to turn and it's going to do what it's going to do anyways. I'm taking today as a day to set up tomorrow, right? I don't see anything really, any aggressive actions coming in today. Day traders aren't doing anything. Swing traders aren't triggering into anything. Investors are kind of in the wait and see mode. Trump was giving a speech to the UN today. You got the Fed tomorrow, and then you got then you got durable goods on Thursday. So I think today is one of those days where you just kind of set up what you're going to be doing over the course of the next few days. For example, we'll talk about this here in a little bit, but one stock that I'm, kind of keen on is Wayfair here. We talked about it in our pre-production meeting. Now, Wayfair is triggering in a potential trade here, but it doesn't have a lot of action, just like the market doesn't. Look at the volume here today so far, hardly nothing on the volume here. And so I'm not, even though it's confirming today above the previous day's high, I'm not going to make a trade. I'm going to wait until I see that set up. And if I get continuation coming in tomorrow above 140, it's currently at 138.81. If I see that break above that 140 level, I think that's a very good trigger. Don't expect it to happen today. I'm waiting for it till tomorrow.
A warm welcome to our halftime crew. Looks like we got quite a few of them popped right in. Shout out halftime crew. I love that. Seeing that hashtag. I mean, is that what they say when you got to get your own hashtag, Matt? You got to create it.
Hashtag, baby. It's hashtag. It's halftime crew.
Hashtag, baby.
We love the hashtag.
I just put a link in. Actually, I want you to click on it in the Treasury yields, treasury.gov, I believe is what it was, Matt, inside of our chat. And I want to show you something actually in this table that's going to be very important. Every news article that you're going to read about the Fed is going to talk about a rising interest rate environment. And I think this actually kind of explains where rates are right now. Mm-hmm. You have the 1 month interest rates for 1 month treasuries, 2.07%. Now, that is actually competing with the dividend yield for the S&P 500, all those first year ones probably. That's where their competition is. But the 2 year at what is that number right there right now? 2.83. Starting the month, Matt, on 9/4/18, it was only at 2.68. So they've been rising on the 2-year, right? And then the 10-year note, what are the numbers on the 10-year right now?
10-year note, it started out the month at 2.9%. It's currently at 3.08%. Both of them are on the rise pretty aggressively this month.
All interest rates are rising in the economy right now, and that's the assumption of what the Federal Reserve is going to do tomorrow, and it's translating into the bond market. You'll hear this, guys.
That's why you hear it's built into the price, because that's what the entire market has expected for the last 6 weeks, is for them to raise a quarter of a point. And so the bond market is reflecting that increase in the interest rates. And you're going to see a lot about the inverted yield curve and the 2-year versus the 10-year. And the bond market is an extremely difficult market to actually understand. So many different avenues in the bond market. Tim, if you can just take a moment to explain what the yield curve is and why that's important, because obviously it's in the headlines a lot today.
Well, historically, and you'll notice the table, a very normal and functioning bond market is going to have a lower rate on the shorter term maturities, Matt. So you should get a lower number on the 1 month than you should on the 30-year, right? And it should be very orderly, 2.07, 2.22, 2.38, so on and so forth. Now, you can have a yield curve in between any two maturities. But the two most popular and famous ones that investors and traders and authors will talk about is the 2-year bond relative to the 10-year bond. And right now, the yield curve is 2.83 by the 3.08. So you have that basis points different. And if I'm doing my math right, Matt, that should be a 25 basis points different, right? And over time, those relationships can change. In 2007, oh, this is fascinating. I love this. You'll notice the yields were a lot higher.
Well, not only that, but then you actually had inverted on the 2-year. The 2-year was paying out at 4.8 versus the 10-year at 4.6. That was at the beginning of 07, coming all the way down here to the to mid 07, kind of when the market started topping out here. And the 2-year chart, once again, just kind of show you this. 2-year chart's right here, 10-year chart's right there. So the 2-year coming into the mid of the year here was about five points versus kind of the 10-year of 5.11. And then all the way down here to 2018, at the end of 07, you basically had a 3-point versus 3.7. So you saw it keep on increasing, kind of into that range. We're not there yet, Tim, but are you getting a little concerned that the 2-year is catching up to the 10-year? Because what that reflects is that short-term concern, right? That's what that 2-year reflects. If there's a higher demand for the 2-year versus the 10-year, that's because people are typically concerned a little bit about the economy.
I would be concerned about it. It would reflect definitely risk in the economy. And let me make sure I explain something very clearly to our halftime crew. I don't trade bonds. Okay. But I watch this relationship. See, in the capital markets, you have debt, you have equity, you have derivatives, you have commodities, you have the core products, Matt, that actually make up what the market is, right? And this is the debt market. Okay. Now, there are other forms of debt. There's corporate debt, there's international bonds that you can buy. But the treasury market in the US is the biggest, most stable market. And it's never had a default in its history, right?
Its history.
So internationally, this is the most important market. That's why we're watching it.
It's also most likely the second biggest market in the entire world next to the Forex market.
It's bigger than the stock market for sure. Yeah. I mean, the derivative market depends on whether you count what it would pay out as or not. But it's a little bit different.
It's between 600 and $800 billion daily. I mean, we're
of value. Yeah.
Massive value here. Now, that's not traded daily. I'm just saying massive value on a daily basis.
Well, and actually, let me look up something. What is the current dividend yield on SPY?
1.87.
Okay, so think about this, guys. Many big investors, if you've got to push a lot of money into the market, I'm talking about institutional money managers, Matt. One thing that they look at is what is my return going to be in stocks versus what my return will be in bonds, and then subtract the inflation rate, right? In the bond market right now, you're going to get 2.5 or 3%. Depends on how much time you buy on the yield. Not a lot of money. The inflation right now, based on CPI and PPI, is about 2.5% if you trust what you're seeing there, right? Yeah. And may or may not. The dividend yield on the SPY is lower, but people still buy stocks because of the potential for price appreciation in the stock market.
Yeah, I mean, if you buy that bond, that's what you're getting paid, right? If you buy the S&P 500, you're getting paid 1.87% on dividend, and you have the ability for growth. You also have the ability for downward movements in price. That's why the bond market is typically considered a safe haven market. But are you concerned, like we were back in 07 and 08, and what the headlines are out there right now? Are you concerned that that yield curve could put undue pressure on the stock market? I mean, to me, if you start seeing yields go up and people start getting a little concerned out there, and you can lock in a 2.83% or a 3.08% or whatever the case might be, if you can lock that in right now and you can take the risk out of the stock market, that's the concern for the marketplace, right?
Mm-hmm.
But we've seen this come close in 2018. In June, it got close to the inverted yield in 2018. And at that point, we didn't see any market volatility. So I don't want people to freak out, right? Just because we're getting a little bit of headlines with a potential inverted yield. We're not there yet, and the market has not responded. And it's I'm really starting to like Mark Stead over there at Twitter. I love what he said about it today, and I can't remember exactly what he said, but let me kind of try to look it up here. So trading.
And while you look at that, I'll answer your question. I'm not concerned about it. It would take me this fast to buy stocks over bonds right now.
Oh, yeah, me too.
So but again, personally, I probably have a little bit higher risk appetite than say somebody at 70 years old and at retirement that needs fixed income. Obviously, I'm younger and I am willing to take on more risk. Well, I still think
let me just read
Warren Buffett said that he would buy the SPY to heartbeat.
Oh, absolutely, I would as well. But that's just a few people. The inverted yield curve is a real situation. Rising interest rates are a real situation, and rising interest rates typically do have a tendency to have a lagging drag effect on the economy. So even though we're not really taking it to heart today, it is concerning over the next 18 months to 24 months that could have a severe impact on the market downturn. And I'm concerned about that, but I'm with you, Tim. Just because the yield curve is going up and just because the 2-year is getting closer to the 10-year doesn't change the fact that the market trend is still the market trend, right? The trend is a trend, the pattern is a pattern, support is support, resistance is resistance. All of that is much more important than a hypothetical conversation on how the yield curve and rising interest rates could impact the overall marketplace. When the market wants to tell you it's fearful, the market breaks support on increased in volume. That's what the market tells you. And I love what Mark put out here on Trading Justice Twitter. He said the 10-year Treasury yield just climbed just south of 3.1 at 3.98 this morning. Earlier this year, it seemed every time the yield curve approached 3%, the market panicked. Now at 3.1, no one cares. Just a reminder to ignore all the nonsense. And
did he say nonsense there, Matt?
He didn't say nonsense. He said bullshit, but just ignore the nonsense and trust the chart. And that's what I'm coming back to. And that's what you got to, make sure that you're focused on is ignore the noise out there, right? Mm-hmm. Ignore the noise out there, ignore the headlines because that's all they are, headlines. Focus on the chart. The chart's going to tell you. And right now, the S&P 500, despite yields going up today, despite all the headlines, is literally doging less than a point on a $2,900 index, Tim.
Part of my daily routine, guys, is to look through all the different markets for a reason. It's so that when I get down to the individual stock that I'm supposed to pull the trigger on, I can do it with confidence, Matt. It's called a daily routine, and we have these processes for a reason. Great book on the topic by John Murphy on intermarket analysis. If anybody ever wants to read about intermarkets and how they relate to each other and whatnot.
I think that's been a book of the month on the Trading Justice podcast.
Sure has. I think it's been about 25 years since that book was written. Yeah, S&P on a doji today, the 10 years at 3.1%. But like old Mark Stead said over there on Twitter, it is a little bit of BS headline right now.
On the chart.
If it does invert, though, I will tell you that will be news. There's no doubt about
Absolutely, no doubt. Yeah. But I also want to say that that's one of the reasons why the Halftime Crew comes here every day is to make sure they get the truth. They get the truth of what's happening in the markets so that we can help them navigate, all this news and all this junk because we've seen this before a million times.
Yeah, definitely. S&P obviously on a doji. Let's go through all the different indexes, take a
Yep.
peek at them. The Dow down 12 points. It was actually up about 40, 50 points this morning, but again, kind of a low range candlestick, not a lot going on. Light volume in the market here today as well, guys. There are some opportunities, Matt, in my estimation. In fact, I wrote down a bunch of entry points I think are close today. We'll
Yeah.
take a look at some of them in a bit.
Well, and speaking specifically of the Dow here, obviously the Dow is very heavy in industrial stocks, but it's also heavy in finance as well. But if you just look at the industrial sector here, Tim, on XLI, that to me is
Different chart.
it's setting up to a very
Yeah.
good potential buying opportunity. So even though the YM, the Dow Jones Industrial Index, is overvalued on the short-term price movement, and you might be a little hesitant because we don't have that Goldilocks retracement yet on the Dow. Once again, let's just take a look at that. Tim, in your Goldilocks retracement type situation, I'm just going to make you happy by drawing a Fibonacci here. That that Goldilocks retracement comes right back down into those moving averages here. So you're still a little overextended on that short-term price movement in the Dow as it's hitting its head at that all-time high resistance zone. So, to me, this isn't necessarily a trigger because we haven't got necessarily the retracement we looked at. But if you just look at the component of the industrials themselves, you're seeing a deep retracement coming back down into that 20-day moving average, that Goldilocks retracement. I'm looking at that as a potential buying opportunity, not today, but again, coming into tomorrow and the next day.
The thing about it is, Matt, the XLI as an industrial sector has Boeing, 3M, Honeywell, Union Pacific, United
Caterpillar.
Technologies,
Yeah.
General Electric, Caterpillar, Lockheed Martin. It really is the
It's all your
industrial sector.
industrial. It's all your industrials.
But the Dow Jones is not just industrials. It has
No,
JP Morgan and Apple Computer and all that kind of stuff. So,
got Johnson and Johnson in it.
sure.
I mean, there's some service companies, there's some healthcare companies. It's by and large industrial and
They
finance,
could
but
just call it the blue chip index, by the way.
well, that's what I call it.
Yeah.
I mean, I call both the S&P and the Dow Jones blue chip indexes, and then you got your Russell 2000 and your Nasdaq. Those are more aggressive type indexes. But again, just sometimes when you look at the Dow, you're thinking industrials, and you're like, oh, there's no plays out there right now. But again, if you just strip it down to the actual sector itself in the industrials, it's setting up pretty good.
I agree with that. Move on to the Nasdaq. I like some of the plays in tech here today, but I've had concern about tech now for a couple of weeks. I'm still bullish in general because of the trend and the overall strength in the market, but it's just not getting any carry through. You had a good candle yesterday, followed by a doji. The whole market's dojiing. Good candle on Thursday, followed by a sell off. Good candle, bad candle.
It was the Russell 2000 2 weeks ago.
Yeah,
That's what it was.
it's feeling that way.
Well, back to I got a feeling, but I got a feeling based on price action, right?
Mm-hmm.
It's back to kind of where we were doing this last time, where it just kind of comes up and you expect it to kind of break and you expect it to kind of run on that. Then you get a big down day. It starts to approach again, big down day. So it's just kind of just chugging along right there, kind of in a neutral type stagnation pattern. But on the NASDAQ itself, a break of 7,600, which is a fairly significant intraday support level, that could run fairly aggressively up another 100 points to 7,700. So I'm more bullish on the Nasdaq than I am on the Russell 2000. I'm not bullish on the Russell 2000, but that 7,600 is a level to definitely track from an intraday perspective. If you see strength above 7,600, that's going to be a really good buying opportunity in a lot of those tech stocks.
Yeah, give me the Russell real quick. The one thing I will say about the Russell today is it does have the most strength from a percentage standpoint in the market. Not a lot still. It's just up 7 points, but you are seeing it's decent candle in the consolidation out of all the different indexes. Pretty much a know-nothing day on the market. The dollar is flat. Actually, it was selling more aggressively this morning, Matt. I thought you could have got some action in this market as it was pivoting.
Consumer confidence was really positive today, though.
It was great.
And one thing you got to understand about economics, and I've said this before, but these economic reports have a bigger direct impact on the dollar than they do on the actual stock market. You have much more correlation between the value of the dollar and the status of the actual economy. And when the consumer confidence report came out, it was widely expected to drop a little bit to 132, Tim. but you went up to 138 on that consumer confidence report. That is the highest number since 2000, Tim, since before the dot-com crash. And we've seen this all year long. Consumers are euphoric about the economy. They are spending all of their money. They don't care about anything right now. They are as high as Elon was in that podcast interview with Joe Rogan. They are literally loving life right now. So again, consumers, thank you for keeping the economy trucking by spending all of your money. We appreciate that as traders. So in terms of this, when you're looking at the dollar was showing a little bit of weakness today, but that gave it a little bit of a support level with that positive economic report.
Yeah, still a low range candle. I mean, we're looking at this market and it's not really moving anywhere across the market. But maybe crude oil just a little bit, Matt, but not even there. As you go from the dollar into the commodities, I'm looking at gold up $1. I mean, stuck in the middle of the range, 12.20 and 11.90 that we've been talking about. Silver kind of flat to nothing. I don't see action in the overall broad markets, and which is where the individual stocks
is nothing burger day. That's what this is. This is I'm going golfing early day. That's what this is. Okay.
It's a dirty burger combo. Is that what it is?
It's a nothing burger. It's a nothing burger. That's what this is.
What's a nothing burger? Is that like a goose egg, a zero?
It's nothing. It's move on.
A nothing burger is a move on. I like it. All right, nothing burger. I like it.
Nothing to see here. Come on.
Take a quick peek at crude oil, though. I do want to talk about that chart. So much news on crude oil. I read a report about Iran obviously shutting down some of the supply based on that November deadline they have on the sanctions. They were calling for President Trump to revisit some of that based on his posturing.
I don't think Trump cares.
I don't think he's going to.
I don't think he cares. In fact, he kind of blasted Iran today in his United Nations speech to the General Assembly there in New York today. Interesting speech by Trump, but he then went to Twitter and said, I'm not taking any meetings with Iran, with the Iranian president, despite multiple requests. I'm sure he's a wonderful gentleman. That's what he said. Oh,
well, diplomacy at its best, I guess. I mean, well, and the reality is,
well, about Trump, he's entertaining. He keeps me entertained.
There's no doubt he is entertaining. From a supply and demand standpoint, though, Matt, those sanctions go in, you have less supply out in the marketplace, and that is one indicator as to why crude is going up. We asked it yesterday.
What's the other indicator? The other indicator is OPEC basically telling Trump that if you want decreased oil prices, stop tweeting.
Yeah.
That.
But also could be from an economic standpoint, it could be consumers though, right?
But I don't think that's just I don't think that is just a nothing. That Saudi Arabia, Iran, OPEC nations are saying, Trump, if you want decreased oil prices, stop tweeting about us. I don't think that's nothing, Tim.
The oil producing countries, very interesting,
are now basically stating that oil will not go up or down based on supply or demand, but it will go up and down based on the subject and manner of Trump's tweets.
I doubt they have that much control over the price, by the way. I know that we always give OPEC all that control over the price all the time. There have been times where it was in a bear market. They couldn't make it go back up. We have to talk about
2014.
Well, they didn't make that thing go back up when it was crashing. They tried to find a bottom on it. It's not like they have the strict dictates on what the price will be.
Drive the value of oil through supply and demand and rig counts. Absolutely, 100%. I just disagree with that statement. The same way that Jamie Dimon can drive markets, they can absolutely drive markets one way or the other.
Yeah, I agree, but there is also a free market. You do need supply and demand, and whatnot. And I think that part of the reason why oil is going up is that you have international demand and strong consumers. And you look at the consumer confidence report. The average consumer is out there spending and they're moving money around the economy and whatnot. I don't know. The question is, do you buy this breakout?
No.
Not me yet either. Gold and silver stuck in a range.
Like I said yesterday, I think you could do on USO breaking above 15. But in crude oil itself, I'm not buying this breakout in crude. I mean, Brent crude is much, much stronger than U.S. Crude line. So if you're looking to buy specifically in oil, I would go to Brent crude more than I would crude light right now. But USO, I think, is still setting up as a strong buy, as a strong position.
Long-term buy, yeah. Social media companies in the news here today, Matt. Facebook down earlier today. I think they'd recovered quite a bit here and almost flat for the day.
Basically, they're flat for the day.
The co-founders of Instagram were resigning. Now, I did not know what the significance of that was. Just saw the headline, saw the stock was down, but now it's come back.
Saw the headline last night. Check the overnight numbers, and as long as 160 holds, you're not doing anything on Facebook.
Are they resigning for personal reasons, disagreements with Zuck? Do we know anything about that story?
I have not looked into that story, but I'm also not that interested in that story. I think Elon losing half of his executive team over the last 50 days since he sent out that now infamous tweet funding secured has much bigger implications than the co-founders of Instagram leaving Facebook.
Snapchat actually also doing some headlines here today. SNAP. It rarely has good headlines. It looked like they're trying to partner with Amazon a little bit in terms of how people can consume products. I would have expected a bigger bump, but still an ugly chart. Bad company.
Hold on. Just because they throw Amazon, they're supposed to get a bump. That changes the fundamentals of this horrible company.
Usually that's how the market works with Amazon lately. I mean, anytime somebody's going into business with Amazon, they usually do rally a little bit.
It's like in 2017, if you said you were if you were a cryptocurrency or you were blockchain, I mean, your stock price went up dramatically, right? You're seeing that with the pod stocks today. If you're associated with the pod stocks, you're immediately volatile and all that jazz. And so all of a sudden now Snapchat tries to tie itself to Amazon. We're supposed to expect this massive price move. And I just don't see it. I think this is a terrible company. I've always thought it was a terrible company. I would never recommend anybody buying this company in any capacity.
There was a merger overnight with Barrick Gold, ABX, two of the big, and I think it was Randgold, I believe.
It was Randgold.
Yeah.
Barrick's buying Randgold. I love this merger. I think this merger is significant for the miners. These are two of the bigger mining companies out there in the world. It's a massive deal. I think it was a $6 billion all stock type deal. I think it's a big deal for Barrick.
I do as well. Obviously, I'm not going to buy on an M&A news item. That's not something that you chase or run after.
You know what I will do, Tim? I will buy after the next retracement off this W formation, though.
When I heard the news, I instantly went to Freeport Mac. And if you go look at FCX, I expected maybe a bump in miners in general, and that's still an ugly chart. It did not carry through.
I mean, if you're looking at the miners, and GDX is kind of all of the miners here, just sitting right there, flatlining at $19 here. So the miners itself did not get a bump, but but ABX, Barrick Gold certainly did. I like the merger. I think this is a smart merger by Barrick and Randgold.
One stock that we have to prep here today is Nike. Nike is the major company that's going to have news after the bell. They got earnings tonight, Matt. Obviously in the news last month with the gap down on the Kaepernick item, we talked about that as an opportunity. It instantly rallied to all-time highs.
Talk about that as an opportunity. We said both of us were buying.
Yeah, it was a great setup.
How dumb that was.
It was a dumb gap down. And sometimes those gaps can create opportunities for sure.
Opportunities. The gap down on people burning Nike shoes. It was the dumbest gap down I've ever seen in the market. And all of a sudden, I just felt it was such a wonderful buying opportunity. And now, it's stagnating and you should be out of those trades. And everybody should, say thank you for the people that burning Nike shoes because that made all of us money.
Is there any play on earnings here?
Well, let's analyze that. Whenever you're dealing with the earnings, you gotta go through your process, right? My process, step one in earnings, is I go look at the gap ranges over the course of the last four gaps. That's personally what I do. Step two is I then compare that against what the market maker move is, and we'll look at that. Step three is to determine whether you expect it to gap more than the market maker move or gap less than the market maker move. If you expect it to gap more than the market does, you know immediately what you're trading there. You're trading the Devicon or you're trading inverted butterflies, correct?
Mm-hmm.
Okay. And if it gaps less, if you expect it to gap less than the market maker, you immediately start thinking iron condors, or if you want to be a pure a pure volatility type trade, the short strangle, right? So if you're looking at this, and I want everybody to kind of do this on their own as well while we're going through this analysis so that you can kind of look at it. Now, when you're looking at that expected gap range, ladies and gentlemen, you can't just look at the dollar figure, because the difference is, $3 to a $70 stock is different from $3 to a $50 stock. You got to look at the percentage of the gap range as well. So first and foremost, Tim, help me. And I'm just going to give some, kind of base numbers here. 71.5 to the opening price the next day at 78.5. That's about a $7, right? Yeah, so Tim, give me, so $7 divided by the price. That was about a 10% price movement on that one. Mm-hmm. The time before it, right back here, you basically, you did nothing, right? You went from 64.50 to the opening of 66.50. That's a $2 price movement. $2 off 65. So 65 divided by, that's a 3% price movement. The one before this, you're looking at right here, it went from the closing price of, we'll just say 65 to the opening of 61. That's a $4 price movement. And the current stock price at the time was about 61. So I'm taking 4 divided by 61. That's a 6.5% price movement. And then the time before that is all the way back here. And you're looking at about 50. The closing price was about 53.50. Opening price the next day, 52.50. So that's a $1 price movement off a $51 stock. So that's about a 2% movement, right? So you're kind of all over the board here with what Nike has done around earnings. One gap went as high as 10%. One gap went as low as 1%. The market maker move right now on Nike, Tim, if you look at Nike, is $4.39. Okay, $4.39 divided by the sticker price at 84. Mm-hmm. That's an expected gap range of 5.2%. So what you have here is you have an expected gap range of 5.2%, which would put you in the actual market maker move right there is 4.39, current price of 85. So you're talking a gap range somewhere between 90 and 80. We'll just call it 90 and 80, somewhere into that range. Mm-hmm. The market expects that type of gap range right there. Okay, so the question that I have for you is based on the historical norms: one gap 6.5, one gap 10, one gap 3, one gap 2. 2 times this gap more than the market maker move is expected this time. 2 times this gap less than. I don't see any discernible edge you have here.
No, I don't either. I mean, for me, I would not want to go short volatility because I don't think it's baked into the price yet. I think there's too much risk on the one gap. When I see that one random gap at 10%, the rest of them all over the place, it kind of makes me very cautious. It could blow up a short strangle, and I don't like that. So then I lean potentially towards an inverted fly, and then I have to wrap my head around what the logic would be. Well, is it possible that all this stuff with Kaepernick has ran the stock to the high because people like us said it was stupid and we went out and bought it, and now Nike's got to come out and perform and maybe they miss? I mean, the earnings whispers that they're going to beat. It's a speculation play for bidirectional, Matt. I don't really see a play here, but
I see a beat in Nike's future. I see a beat, but I mean, they have added $6 billion in market cap since that Kaepernick situation. And I want you guys to think about that. Here's Nike, a company who is a global company, right? They're not a U.S. company. They are a global company. Here's Nike looking at the global situation right now, makes a bet for the future. People come out and say how horrible it is. And yet 3 weeks later, there's $6 billion more in market cap. Whatever they spent on Colin Kaepernick, he should have got paid more.
Sure.
But the question, but with that said, I do expect to beat, and I do expect to beat because of this one reason. Last earnings season, everybody beat, Tim. Everybody beat.
And the companies almost, yeah.
I mean, like, what was it? 75, 80% of companies beat the expectation.
It was the best quarter in like 10 years. I mean, it was an incredible quarter for sure.
And what's happened in the economy? What's happened with consumer confidence? What's happened with retail sales? What's happening with every economic indicator we've seen in the last 3 months all of those have been mostly positive, especially consumers. And we know consumers love buying shoes. So I don't know, it's anybody's guess, right? It's anybody's guess whether they're going to beat or not, and it's anybody's guess whether or not the market responds to that. The question comes back to the analysis. Your short strangle isn't going to work here, right? Just based on that one gap, it's going to make both of us a little concerned with that. But do you have an inverted fly here?
Well, you do. I mean, you could sell the October 87, 85, 83 inverted butterfly. That's half the market maker move. The tricky thing with that one is the commissions on doing all those legs. So it depends on how you have your commission structured and whatnot. You're only getting a 25-cent credit, and you're not going to materialize all of that credit no matter what. Strikes? 85, 87.
83.
And 83. Yeah, 2-point window on both sides.
You're just not getting it. 19 credit.
Yeah, there's just not enough money in that thing.
You're just not going to get it. I mean, the fly is not going to work here. You want to make a play. I want to make a play. I like trading earnings. I like the feeling right when that bell closes and that 1 minute chart on the intraday, it's going to spike one way or the other, and you get your blood pumping and your heart beating a little and you start saying, am I going to make money or am I not going to make money? I mean, literally, within 5 minutes, typically, whether you're going to make money or lose money on that trade. And I like that feeling. It's fun. It's energizing, but you can't force the action. You got to let the setup work. You got to run your numbers. You got to look at the volatility. You got to play it out. And the only thing I think you got here is perhaps an inverted fly, but you're not getting any credit for that.
By the size of the company and the consistency of the revenue, guys, I would tend to lean on short volatility and short strangle. Because of that inconsistency in the gap, Matt, I would avoid the risk.
That one gap. If we were just looking at the other three, we would probably say short strangle here, but that one gap, plus Nike adding $6 billion to it, plus Nike being in the headlines, plus Nike at an all-time high. I mean, it makes me just kind of uneasy about the short volatility play here.
You know what the play will probably be is in the morning, if it does gap for a gap fill, look at every gap on Nike. It settles back.
It does. Well, look, we hit it there. That one didn't work, by the way. We hit it there. We hit it there, and you might see this same thing. Gap up, retrace back down, something similar that we saw.
If it gapped down, a bull put is in play. And if it gaps up, a bear call is in play.
If it gaps down to the 20-day moving average, if it even gaps down to the 50-day moving average, yeah, bull put's in play, no doubt.
Yeah, we'll take a peek at Nike tomorrow. I've got a bunch of symbols here, Matt, I want to take a look at. We got a few minutes. I've got all kinds of bullish setups. There's no doubt about it. I love Adobe. I love Costco. I love that W stock that you were looking at. Adobe was on the option report this week. It's one of my highlighted picks for the week.
It's triggering.
You'll see the trigger. I mean,
it's triggering.
It's an expensive stock, so use spreads there, probably there, guys.
Oh yeah, bull call spread, definitely. What was the one that you said after Adobe?
I do like Costco, but it's not confirmed yet. And we looked at Costco yesterday as well. It's still waiting.
On the stock report, the trigger was above the not above the highs, but it was above kind of this channel right up here, about 236. And so that's something we're all looking at right now, but it's just not triggering. I think right now a close above the 20-day moving average is kind of what you're looking at. You get a close above the 20-day moving average, I think you can trigger into that. I like that call too. One we talked recently was Wayfair. We talked about it again earlier today. To me, this one's an easy trigger right above 140. That's pretty clear to me. So I'm looking at that one as well. But Tim, again, with Adobe, with Adobe triggering today, with Wayfair approaching it, I'm still a little cautious pulling any trigger coming into tomorrow. Right? Yeah. I just am. I'm a little cautious. Yeah, because I really don't need more bullish delta.
That's right. That's exactly right. That's where I'm at too, which is why I've got some bear setups I do like as well. WDC, Western Digital, WDC, I think is a really good setup for bear.
Sorry, Western. This is about going to happen to you. You just need to understand that all the traders are going to drive your price back down to 55.
Yeah.
It's just going to happen. It has nothing to do with you, Western Digital. I don't know much about your company. You are probably fine individuals, but that is a hair trigger underneath the 20-day moving average off a retracement in a trend that's increasing momentum. That's a great find, Tim. Sorry, Western, but that's a great find.
And what you just said a minute ago is really, really important for all of our halftime crew out there, guys. If you've already got a bundle of bullish trades, you can't just keep putting money into bullish trades without balance. One of the most important things you can ever do in trading, Matt, is to beta weight your delta so you understand your portfolio risk. I think.
Well, here's the question I have for you then. Okay. So take a couple trades that we've been talking about recently. I'm in Microsoft right now, showing a little bit of weakness today.
Yeah.
Everybody knows how much I love CRM, showing a little bit of weakness today. So the question, and these aren't long-term positions, these are swing/position trades is what they are. Basically what I did, Tim, on both of these, I bought enough time on the options that I had the ability to either swing or position trade. This is basically what I did. So for me to put that trade in on, Adobe or on Wayfair, which would add more bullish delta, I would have to take off something in, say, CRM or in Microsoft. Now, that's a healthy debate internally, right? So you tell me, Tim. I'm going to just trust you on this. Looking at these three trades, okay, and I don't need more bullish delta, right? I don't. So looking at these three trades, should I lock in profit on CRM and Microsoft to go put it into Wayfair and Adobe?
I'd be more likely to lock it in on Microsoft than CRM. I actually did my own pay range analysis on CRM today, and I think the target's got to be 160. I know it's only $2 and you've got the rest of the day and tomorrow until the Fed, but I'm not worried about the Fed too much, quite frankly. And we'll know much more by tomorrow morning if you got to do something with it.
CRM's got about a 10-point pay range.
And I think that 160 is the minimum target, Matt. That's like your first target. So
yeah, 162 above that. I mean, so you're 160 to 162, and that's kind of my target as well. Yeah. You're at 159. I probably will by the end of today lock in on CRM and on Microsoft to set up trades for tomorrow on Adobe and Wayfair if it triggers.
Well, and that's trading. I mean, you're taking
Digital, money. I'm gonna put that trade on Western Digital. Just give me some bearish delta.
Sure, and you're moving money from one setup to the other. If you do like Wayfair, if the question is, would I rather have my money in Microsoft or Adobe triggering? It's Adobe.
It's Adobe on short term, right? Long term, you're not doing anything here. I'd much rather have it CRM or Microsoft long term. But these are both short term type trades. Like I said, they're swing trades to position trades. Both of them are approaching targets. So, if you're looking at the reason we brought this up, guys, if you're in that situation where you're looking at your delta weighted portfolio and you're like, I have too much delta, I am too overtly aggressive. And that's a halftime tip here, pro tip, guys. On a day like tomorrow, where you have a massive economic event that may or may not drive the market, but definitely has the ability to do that, you need to check your delta. Check your portfolio delta, right? If you have a very strong bias one way or the other going into an event like that, yes, it can feel really good if you're right, but it can really feel the burn if you're wrong on that. So I would check that portfolio delta, and I think if you're carrying anything besides a slightly bullish delta into that event tomorrow, I think you're making a mistake.
Cody, I think you had one set up as well, young man. Come in here, share it with the team.
My setup for today is Hog, good old Harley Davidson.
Everybody loves Hog. Everybody loves trading Hog. I'll tell you, I literally had a guy one time tell me, and I was in Texas, Cody, and I don't know if I was in Houston or Dallas, but I remember a guy telling me I was looking at a potential short position on Harley Davidson. It was in a really good bearish downtrend. I was teaching bearish trades, buying put options, and he said, it's un-American to short Hog. And I said, yeah, it may be un-American.
Don't they ship most of their parts internationally?
Yes,
I always find that whole thing.
They build,
they build in Europe too. So all I said was,
drink American beer, drink Budweiser from Germany,
American, but it's not capitalistic. So
something I like in addition to the setup is, Matt, go ahead and add the 200 on that chart. It broke the 200. Came back down to test, and now it's breaking back above the 200. So not only do we have it on a nice setup, we have a potential strong long-term reversal here?
Habits. I always call it my 200-day moving average green.
Me too. I probably got that from you.
You got that from me. And you know what, Cody? I got that from my mentor, and he got that from his mentor, and he got that from his mentor. And that's how you learn how to trade, is you learn from the people who've been there before you. Yeah, I like it. I mean, the last 2 times, it's got to get above that level though, right? This is something for me, you know, it's closing above the 200 right now. That is important. But we saw this recently. I would need some action above this resistance level, right about 45.5. But I like that one. Last time it's been below the 200-day moving average for quite some time. But the last time it broke, it did run quite aggressively.
Well, and you've got some time between now and the next earnings, which gives you the ability to position trade this, not just swing trade it. I like a lot of the different setups. The breakout at 46, I think is triggerable. I think that a deeper pullback could be triggerable. I had hog on the option report from the weekend as well, and I'm wearing my Harley David T-shirt today, Cody. So, by the way, I don't drive a hog. In fact, that's how little I know about motorcycles. I called it driving them. So I've never owned a motorcycle.
Every day I'm questioning your man card.
Hey, I think I would like it. I just never have done it, really.
Listen, I can't say much, Tim. I rode a motorcycle one time when I was 12 years old. I wrecked it pretty bad. Didn't know how to get off the motorcycle. Kept pulling down on it. It was driving me up our hill. You remember Black Hill, right? So it was driving me up the hill. Never rode one since. So I can't say much.
You know, growing up in the family I did, Matt was the reason we couldn't have nice things, Cody.
What is it? What's that called? Where the bike starts getting away from you, and when it gets away from you, you actually crank the throttle more, and
whatever that's called. That's what I did. Okay, that's what I did. We also got a 4-wheeler one time for Christmas when I was 15 years old, and I decided to go see how far I could jump it. I jumped it, and it hit another jump, and it rolled it, and it hit on the back of my head. I don't know what that has to say about me. But, Tim, don't get me started. When you wrecked that 4-wheeler on a 3-foot hill down in the desert, that was the worst thing I've ever seen. Don't get me started.
They call that ass over elbows, Cody.
Ass over elbows. I like it.
Did you just Google it?
I don't know what it's called. I don't know.
Hey, Marie, I would definitely take a ride.
See, this is what happens when certain stocks trigger certain emotions, right? If he would have said Disney, I probably would have went on a 45-minute rant on Disney and everything Disney related. But I do
looks like all of our commenters calling it a whiskey throttle.
A whiskey throttle. Is that what it's called? The whiskey throttle? That's what I did. Adam, Justin, Daniel. I whiskey throttled it without the whiskey. I was 12. But I take it back here. 40. I said 45.5, Tim, on the trigger on hog. I like yours better. Above 46, I think is a strong buy.
I think that breakout there is probably the better trigger point, in my opinion. Yeah. I mean, I agree with either of them. But all right, guys, I got a couple of questions for the halftime crew as we wrap up here today. How many of you guys already are a part of our Condors team? Because I know that we have a pretty big Condors team there, Matt, at Tackle Trading. A lot of people are trading that system. Coach Emily, Coach Tyler joined us for the podcast yesterday.
Great podcast yesterday, by the way. Really enjoyed it. You guys go check out the podcast.
And okay, so good. We're doing a webinar tomorrow that for anybody who wants to join us, you're more than welcome to, but it's for people who maybe don't have the Condors yet, Matt. We're going to highlight and promote the system to those who aren't a part of that team yet, right?
Hey guys, heads up. We're going to sell the system.
Yep.
That's what we're doing. It's a great system. We're selling the system.
Yeah. And so if you're out there and you're like, well, what is that? I want to, potentially look at it. Come and join us. I mean, I'm going to be teaching the webinar. It's going to be a lot of fun. I'm going to show you guys the data behind the back testing and, the equity curve and the expectations and kind of talk about what's in the box and all that kind of stuff.
Let me speak to that. When I say we're going to sell the system, I mean, we're going to teach the system. And if you see the value in that, you can be a part of it.
Yeah, we have our own approach to promoting for sure.
We're terrible salespeople.
I don't think so. First of all, I think most people out here would not agree with that. They would say, Tim and Matt, you guys are great salespeople.
I'll tell you
I'm proud of being a good salesperson. I honestly, you're gonna trigger a rant right now. I promise you. Be aware.
Don't rant. Don't rant. It's okay. I embrace all things sales. Sales drives the world. Yeah. I'll just tell you that last night, 3 kids approached my door, knocked on my door. It's about 8:30 at night. and they were doing some school fundraiser type thing, and they were all hesitant. And I leaned down, I said, "You're here to sell me something, aren't you?" And one of the young men, he's like 8, 9 years old, and he says, yeah, Mr. Justice, we're doing the school fundraiser. I said, "Hey, listen, I'm a professional salesperson. I want you to sell me this." And he says, "Well, what do you mean?" I said, "Listen, young man, there's only two things that can happen here. You can say yes or you can say no. That's it. But if you never make an offer, people don't have an opportunity to say yes. That's
Sure.
what sales is about. It's making offers on great content. And some people fear that. I certainly don't. I embrace it."
Well, and I'll give everybody out there a challenge. One thing that you should always do is do what Matt and I did. Build a company or build your own business or work for a company or work for a product that you never hesitate wanting to promote it. And really, I think that's the real key to business is
Listen, it's easy to sell value, Tim.
And if you love what you do, I mean, we love what we do here at Tackle Trading, and #halftime crew, by the way. I'm really proud of you guys. We keep hitting higher numbers each and every show, Matt. We're slowly building something
Love you guys.
special here. Guys, thanks for being a part of what we're doing here at Tackle Trading. Thanks for showing up live here. We've got another show here tomorrow, obviously the Federal Reserve meeting.
I am interested in your anti-sales rant, though.
Well, here's the thing. The idea that a salesperson is a bad thing is silly to me. It's crazy. It's one of the most valuable skill sets you can ever build. And if you just simply promote products and you help people provide value, then sales should be something that you're very proud of. See, I don't want to be sold something I don't want, but I don't also walk on a car lots unless I'm interested in a car, right? I don't ever have a problem being sold if it's something that I go and show interest in, which is why I love the way that we do stuff. I mean, when we do a webinar, we're inviting people to come and join us. And so they know that we're going to be promoting, product, but also kind of teaching
something that's changed your life. You know what I mean? It's easy to sell something that can provide value for people and help them out of any rut that they are in, that can help put them on a better playing field. It's easy to sell things and stuff that you believe so much that has helped your life out so much. So, the word sales gets a bad name from consumers, but hey, consumers, your consumer confidence is 138. Come to our webinar tomorrow.
I agree with that. Oh, so many trades to make, so many things to do by the end of the day.
That's mic drop moment.
You know what's tricky on a day like this? I will have just a random kind of mindset thought of the day is over trading just because you're bored.
Oh, it's a risk.
It is a risk in trading. I'll tell you guys out there, by the time you get to this point in the day, one thing that you should try to do, balance your portfolio, log and journal your trades. Don't over trade just because there's not a lot going on. Run your system, treat it like a business, and make sure you journal everything, because then when you have conversations with coaches and mentors, it makes it a lot easier for us to understand what you've been doing.
Yeah, and I want to reiterate what you just said, because it's so important. On a day like today, when the market is doging, not moving, nothing's really moving in the Forex market, the bond market, the stock market, it's like a wait and see type day. Don't feel the desire to force the action. As a trader, you always need to let the action come to you, and you process the data and take action off that. You never force it. Your money does not move the market. And if the market's not doing anything today, we all have so many other things in our life we can go do, like hang out with family.
C'est la vie. I'm going to go check on my dogs and my girls and get ready for some more Tackle Trading meetings. We're powwowing here in a few minutes. Sadie is doing good enough that she ran from me today and got out of the house and ran down the street. So
I'm trying to do that for 3 weeks.
She's been doing that for a long time.
Sadie is Tim's very, very awesome Great Dane dog. He's had for 11 years now, 10 years?
Sadie's an 11-year-old Great Dane who had a cancer tumor removed recently, and she's been my trading buddy for a long time, Matt, but now she's literally been tied to my hips so that I can keep an eye on her.
Because your other dog, Max, he can only trade Forex. He's that crazy.
he's a crazy dog.
Yeah, he's crazy. But hopefully Sadie gets better and better every day, bro.
Here's the real question I'll save it for another time. I'll wait for another time on this one. Guys, thanks for being a part of our halftime crew. Thanks for joining us. We will see you tomorrow. Cheers.